All right. Good morning, everyone, and welcome to the third and final leg of Business World Insights Phase 1 with the theme laying out the macro scenarios for businesses amid COVID-19. I am Leo Uy, head of Business World's research group, and I'll be moderating this forum. For this session, we'll be talking about COVID-19 and the Philippine stock market. As you all know, volatility in the stock market can be a good thing if one plays their cards right. However, too much of this can be nerve-wracking, especially for those who feel the pain of selling at a loss more intensely than the pleasure of selling at a gain. Unfortunately for us, this has been the case for 2020 so far, as the COVID-19 pandemic has put into question the growth prospects of firms. And it did not help that the Philippine economy declined in the first quarter, breaking its growth streak of 84 straight quarters, or 21 years. Whether you're a risk-loving or a risk-averse trader-investor, one has to know the uncertainties and opportunities that lay ahead. Now we are privileged to have with us three speakers who will share their insights on the matter. First, we have Ramon Monzon, who has been the president and CEO of the Philippine Stock Exchange Inc. for 3 years now. Before taking on this role, he first served as a director of the exchange from 2015 to 2017. He concurrently serves as president and director of PSE's wholly owned subsidiary, Securities Clearing Corporation of the Philippines, as well as a board of trustee of the Securities Investors Protection Fund, Inc. Thank you for joining us, Mr. Munson. Sir, you now have the opening remarks.
Okay. Good morning, everyone. First of all, I would like to thank Business World for the invitation to be part of this forum. I think it's safe to say that at the beginning of the year, all of us were optimistic and had high hopes on the growth and development trajectory for our country. At the Philippine Stock Exchange, we were eagerly looking forward to a very good year, especially with the approval in January by the DOF, SEC, and BIR of the revised rules and regulations for real estate investment trusts, or REITs. For PSE, this meant new listings of companies that would engage in REIT, and for the investors, a new asset and attractive class to invest in. Given the sound macroeconomic environment put in place by our country's economic team, we were eyeing higher average daily trading volume, higher capital raising targets, and of course, higher index level for the Philippine market. At the beginning of the year, most investment analysts were projecting the PSE index to reach anywhere from 8,400 to the 8,800 level. In December 2019, a deadly virus called Covid-19 was discovered in the city of Wuhan, the center of Hubei province in China. This quickly developed into an epidemic there, resulting in Wuhan being locked down by the Chinese government starting January 23, 2020. Covid-19 spread exponentially, wreaking havoc on lives and economies of many countries. By March 11, 2020, the World Health Organization declared COVID-19 as a pandemic. To mitigate the spread of the COVID-19 virus, lockdowns were imposed in many countries, including the Philippines. President Duterte imposed ECQ, or a total lockdown on the whole Luzon Island, which contributes about 73% to the country's GDP. The rest is history. I would like to present a few slides to update the viewers on where the Philippine stock market is now. This should be helpful in framing the forthcoming discussions that the panel members will have in the stock market later on. In the first slide, you will see that the index is down 27.7% and from 2019 and down 37.6% from its all-time high reached last January 29, 2018. Average value turnover is down 12.8% to 6.4 billion from last year's 7.3 billion. The market drop this year was so sudden and steep, resulting in PSE's circuit breaker being triggered 3 times in 1 month alone. That was on March 12, 13, and 19. The last time PSE circuit breaker was triggered was in October 27, 2008, almost 12 years ago. However, looking at all the negative numbers on this slide, an optimist will note one thing positive. That is, the index has gone up 22.2% from its lowest close reached last March 19. On the next slide, you will see that year to date, the Philippine market has been the worst performing market in Asia. Obviously, I'm not happy or proud to be showing this. But being an optimist, I believe that every cloud has a silver lining. And the silver lining here is that when you're at the very bottom, there's no other way to go but up. The third slide shows year-to-date average value turnover being down just 12.8% from last year. But what is ominous in the numbers here is the fact that trading activity for April and May are drastically down to the 5+ billion level. And only the high trading volumes for the first 3 months of the year tempered the drop in the year-to-date average value turnover to 6.4 billion. I must admit that even I can't seem to find a silver lining in this. One of the most important and widely watched metric in our market is the trading volume of foreign investors. Savvy investors pay close attention to whether foreign investors are net buyers or net sellers in our market. In the final slide, you will see that in 2019, foreign investors were net sellers in the market to the tune of 14.3 billion. This year, we're only in May, and net selling by foreign investors has already reached a staggering 52.5 billion, almost 4 times the level for the whole year of 2019. There's no doubt that this massive foreign selling has contributed significantly to the big drop in our market. Is there any silver lining here? Yes, I believe, because local investors apparently have taken up the slack left by the foreign investors in the market. For 2019, local investors accounted for 44.6% of the trading volume. Now they account for 46.8%. What is noteworthy, though, is that for the month of April, local investors accounted for 53% of the market's volume, and for May, 49.4%. Increased local participation augurs well for our market, as it will leave us less vulnerable to the political and economic issues or events in the international arena. In the next hour, my fellow panel members and I will discuss the stock market's prospects and directions for now in the post-COVID-19 era. Most may see a bleak future for the stock market, but as an eternal optimist, I believe there's opportunity in every crisis. Thank you very much.
Thank you very much for that, Mr. Monzon. Our next speaker is April Lynn Tan, who is the Vice President and Head of Research at COL Financial Group Inc. As Head of Research, Ms. Tan handles a team of analysts who covers more than 60% of the total market capitalization of the PSE. She regularly conducts market strategy presentations and appears in local business programs as a resource person for stock market matters. She was also the president of the Chartered Financial Analyst Society of the Philippines, or CFA Philippines, from 2009 to 2016. She received her Bachelor of Science degree in Management Engineering at the Ateneo de Manila University and became a CFA charter holder in 2000. Thank you for joining us, Ms. Tan. Your opening remarks, please.
Yeah, thank you to Business World, and good morning to everyone. Thank you for inviting me and allowing me to speak in the Business World Insights about the stock market. So I'd like now to start out. I mean, usually when I talk about the stock market, I talk about its performance because that's what people really care about. And yes, we're down 27% for the year, but I think what has caught a lot of people's attention is the strong rally of the market after hitting a low of 4,600 to 5,651 as of yesterday. So that's up 22%. So those lucky people who bought at 4.6 are now making a lot of money. So I guess the question is, how sustainable is this rally? And first of all, what was the reason for it? What has changed? I think the improving optimism is first caused by the number of cases peaking. So looks like we have flattened the curve, not only in the Philippines but all over the world. And because of that, economies will reopen soon. I mean, I think yesterday was a disappointment to the Philippines because we're gonna have another 2 weeks of you know, an MECQ, at least in the NCR. But at least, some other areas are now at GCQ, and inevitably we will open. And that should mean better economic growth. There are some possible treatments that are showing promise, like remdesivir. So at least we're, headed towards the end of this crisis. And next, of course, we have the very aggressive central banks globally, led by the US Fed, okay? And governments globally approve aggressive fiscal stimulus programs. Okay, so I just like to talk about the central banks because I think that's one of the least understood developments, or at least if you're not really that into the stock market, you're not too familiar. Okay, so what was the catalyst for the Philippine strong performance? It was actually the strong rebound of the US. So we're up 22% from the low, but the US is actually now up 31% from the low. It's much stronger, and the main reason for it is, of course, the Fed, the very aggressive move of the Fed. So as they said, don't fight the Fed. And you can see how the balance sheet of the Fed has gone up so much. It's now at 6.7 trillion US dollars, and I think among the numerous steps that it did to boost the market or to help the I don't think really the market was the major objective, but it was a consequence of what it did, which was, to do an unlimited QE. So now it has said it will do whatever it takes to support capital markets. And as you can see here, I mean, if you look at the chart, like, so what, 6.7 trillion, but note that it was below 1 trillion prior to the global financial crisis. And over 10 years, that has increased to, say, around 4. But overnight, I mean, in a month or two, it has increased to almost 7 trillion. So that magnitude is quite big. What took them so many years to increase is they now did in a month and a half. So that's really something significant. Okay, and but sorry to say that I'm not really very optimistic at this stage, and these are the reasons why I don't expect the strong performance so far from the low to be sustained. First is because I feel that the economic impact of COVID-19 will be severe. Secondly, valuations of stocks are cheap. However, um, they're still far from previous bear market bottoms. So, of course, that said, that means we could still see some downside risk at in the short term, at least. And foreign investors remain net sellers. And in the past, it's been difficult for the market to sustain a strong recovery without the foreign investors. Okay, so on the economic impact, I just like to cite a very strong indicator that we should brace for something really bad in the second quarter. Okay, because we just came out with first quarter GDP, and as you can see, our first quarter GDP was down 0.2%, disappointing a lot of investors and economists. And you can see here that only government spending was strong, but that said, it wasn't even that strong. Going forward, probably we will still see household consumption and investments and exports remaining weak. The government will be the only one spending, so the outlook doesn't look good, at least in the near term. And then on the valuation side, you can see that yes, we are cheap versus historical. I'm not denying that we are cheap from a 10-year perspective. Do whatever multiples you want, we really are cheap, no matter how you look at it. But I mean, markets are really cheap during bear markets. All I have to say is, in the past, during the Asian financial crisis, global financial crisis, we bottomed at PEs of 9 times, 8.9, and EPS drops of 70, 27%. So, at around 5556, we are currently at 13 times PE, which means that we're still not yet there. There is room to go down. Implied PE drop or EPS drop of 23%, I think, is a bit conservative. I think there is still room to adjust lower. And okay, foreign investors, as you can see here, they've been consistent net sellers. So while we were buying the market, the local investors are buying the market, the foreigners have been exiting our market. And in the past, we have never sustained a rally without the foreigners. So what do we tell our investors? We tell them, if you're a long-term investor, sure, stay invested. But at the same time, right now, when you're buying the market, there is this temptation to throw caution to the wind, especially since the market is strong. Yung FOMO, di ba? Fear of missing out. So, but we're telling them, don't chase prices. Still buy slowly if you want to capitalize on low prices. I think it's going to be a buyer's market. So while the market's going up, stay on the sidelines and wait for them to go down again and buy. And when you buy today, think long term. I don't think you should try to make gains in the short term, or expect to be profitable right away. And that said, diversify, limit your size to an amount that, if ever you are wrong, you should be ready to hold on to a losing position for a bit, because definitely I'm quite confident if you hold on to what you own right now, give it a year or two, we'll probably be in a better position. And another question that we're asked, should you buy the laggards or should you buy the leaders or the resilient sectors? We recommend sticking to the resilient sectors right now. And what are those resilient sectors? So far we have the retailers of essential goods like groceries or drugstores, food manufacturers, telcos, some utility companies, power companies, whereas the vulnerable sectors will be retailers of non-essential goods such as fashion, restaurants, property companies, and banks. So we can talk more about it later during the Q&A session, but that ends my introduction for now. Thank you.
Thank you for that, Ms. Tan. Last but not least, we have Philstocks Financial Inc.'s Japet Luis Tantiangco, who will be replacing Philstocks VP Head of Research and Traditional Sales, Jun Calaycay, who has been feeling under the weather these past few days. With that said, Mr. Tantiangco is a senior research analyst at Philstocks and has assumed the position since last year. Prior to this, Mr. Tantiangco was a research associate at Philstocks starting 2018. He previously worked as an economic researcher at W Group Inc., as an intern at Ibon Foundation, and as a customer service representative at Open Access BPO and West Contact Services Inc. He got his Bachelor of Science degree in Business Administration and majored in Business Economics at the Far Eastern University, Manila, and graduated summa cum laude in 2017. Thank you, Mr. Tantiangco, please.
You're very much welcome, and thank you very much as well for this opportunity, Business World. Now, I would like to greet first a pleasant morning to all of you, to my fellow speakers, as well as to the rest of the audience. Okay, so the stock market is ever-changing. It never fails to bring us new surprises. Unfortunately, the latest surprise that it has given us has brought us down to our knees. Now, in order to further understand what I am talking about, let us look at the chart of the market. So first, you can see the chart of the market here coming into 2020. The precipitous slide that we've experienced has already been prophesied by that death cross, or the crossing of the 50-day exponential moving average, the blue line, below the 200-day exponential moving average, which is the red line. So, as mentioned, this is already prophesied, the decline. However, we were still trying to maintain our resilience. We came into 2020 with mixed narratives. On the upside, there was already the deal, the initial deal or the phase one deal between the U.S. and China, which was supposed to resolve its trade war. On the downside, however, we were already experiencing fears from regulatory risks. This came with the case against the water concessionaires. Nonetheless, we tried to hold our ground. We maintained that sideways movement until eventually COVID-19 came. And as you can see, this pandemic and its adverse effects to the economy, or the expected adverse effects to the economy, which we already saw in the first quarter GDP, has brought us down year to date by about 50%. Okay, so it's an almost 50% decline in less than a quarter. So recently, the market has been trying to rally, and that is shown in that uptrend channel, that green area or green shaded uptrend channel. And as you can see there, we've tried to bounce back from our bottom of around of a little above 4,600, and we reached a high of a little above 5,900. And this was caused by factors like the government's efforts in order to curb the impact of COVID-19 on the economy. That includes the aggressive monetary and the aggressive easing in monetary and fiscal policies. However, the fears and the uncertainties of the pandemic persisted, and this caused the market to decline again. It gave the market a hard time breaching that 5,700 resistance level. And to add insult to the injury, we've already broken below the lower bound of that uptrend channel, which is a bearish signal, indicating that in the near future, we will likely have a consolidation within that 5,300, 5,700 range. If you're going to look at it, the market is still below its moving averages, which is another bearish signal, showing that we still don't have that momentum. Now, for the next slide, please. If you're going to look at it, this is the market's Bollinger Band. And as you can see, prior to the precipitous slide, we were trading sideways. And I want you to focus on the blue lines, okay? So again, prior to 2020, the gap between the blue lines were thin, showing us that there isn't much volatility in the market until the precipitous slide happened, causing wild swings in the market. And this is so far the highest, the wildest swings recorded in our local market. Finally, if you're going to zoom out and look at the longer picture of the stock market, next slide, please. Yeah, there, if you're going to look at it, so after that global financial crisis in 2008, we recovered. At first, we were having a steep rally. Eventually, it lost steam, but it found another trend support on that second green line. Okay, and then we reached that high of above 9,000. After reaching this point, the market has already showed signs of losing steam. Okay, but nonetheless, it tried to maintain a sideways movement within that 7,500 to 8,100 range. And it was still supported as well by that second green line, which is the second trend support. Unfortunately, again, because of the COVID-19, we breached first that 7,500 support line, we breach our trend support, and finally we breached below a major support of 6,800, which eventually led to the bear market that we are in right now. The charts tell us or shows us that the charts show us that we are truly in turbulent times. As skittish as it may be, my reminder is always to go back to the core guiding principles of the market, because there will always be opportunities so long as we employ the right strategies and manage our risks well. And again, stick with the core principles, because by the end of the day, they are what matters most.
Thank you, Mr. Tantiangco. Now that we're done with the opening remarks, let us proceed to the panel discussion. So similar to the previous sessions, we expect a fruitful and free-flowing discussion. So please note that for the speakers, any one of you can just jump in to share their views, even if the question was not initially addressed to you or to them, right? So without further ado, let us begin. So for the first question, I would like to direct this one to Mr. Monzon. Sir, if we recall, the PSE index or the PSE at one point plunged by a record 13.3% day to day, erasing as much as 1.16 trillion in value in just one day. This was around after the 2-day closure when the Luzon-wide lockdown was implemented. And since then, the index has been trading within the range of 4,700 to 5,900, which is way below the record high 8,000 levels, right? So, historically speaking, how does this compare with the previous episodes of in the stock market regarding previous negative economic shocks, such as, say, the financial crisis of 1997 or those of 07 and 08? Is this something that's unprecedented, or is this just a normal business cycle?
Well, Leo, the Philippine market basically over the last 10 to 15 years has experienced 4 major bear markets. The first one being in the 1997 Asian financial crisis, when the market declined by 69%. Then we had the 2000 political crisis when we had a change of president, and the dot-com bubble in 2001, and the market dropped again by 62%. And of course, we had the 2008 global crisis where the market dropped 57%. And at present, we have this COVID-19 crash from an intraday high of 9,078 in January 2018 to the low intraday of 4,039 in March 19, or a drop of 56%. How long does it take? How long did the previous bear markets take to recover? Well, the longest was the Asian financial crisis, which took 106 months to recover. The reason it took a long time to recover was that on its way to recovery, all of a sudden we got hit by the political crisis in year 2000, and then we had the dot-com bubble in 2001. So it took the 2000 political crisis took 68 months for us to recover to the previous peak. Finally, the 2008 global crisis, it took us just 23 months to recover to the previous peak. One thing I'd like to point out here, during the 1997 financial crisis, okay, from the intraday low, which was hit on September 14, 1998, after 1 month, the index was up by 23%. After 3 months, by 68%. After 6 months, by 81%, and 12 months by 95%. For the 2008 global financial crisis, after hitting the low of 1,684 on October 28, the index after 1 month was up 17%, up 11% after 3 months, 23% after 6 months, and 73% after 12 months. For this 2020 COVID-19 crash, we hit an intraday low of 4,039 last March 19, we're at almost 5,600. So in 1 month's time, our market has recovered 43%. So, I mean, so historically, I mean, we've had four bear markets, but as you will see, we've been able to always recover and even reach higher levels after we recover.
All right. Thank you for that, Mr. Munzon. Maybe Ms. Tan and Mr. Tantiangco would have something to add to that.
Okay, I can add to that in terms of comparing the nature of this crisis to the past two, Asian financial crisis and global financial crisis. If you think about the Asian financial crisis and the global financial crisis, those two were financial crises where, they're your regular garden variety type of financial crisis na pinag-aaralan sa school, where, prior to that, you had strong economic growth, and then, of course, banks being very aggressive in lending during both times. And then, of course, you have an asset bubble popping. And because of that, that leads to economic slowdown. Um, so this time around, the crisis is not caused by anything like that. At least in the Philippines, we don't see any excesses. If you look at the companies right now, they are not highly leveraged. And of course, aside from that, the banks have not lent too much. The banks are actually very strong right now. They have very high capital levels. But the problem is, because of the COVID-19 pandemic, the problem is you don't know how the demand will respond, or if it will recover, because to some extent people have become cautious. It's like consumer confidence has been hit negatively, and at the same time, because of that, the businesses, because they don't know if consumers will continue to spend, because they have to do social distancing, they have to avoid going out. If I were a corporate, I wouldn't want to spend either, not because I have no more access to capital. In fact, this time, I'm quite surprised that interest rates are so low. I mean, in the past, usually rates are so high every time you have a crisis, but now rates have gone down so much. So it's different this time around. You can't use the same model. So that said, I mean, initially, I was thinking there could be a V-shaped recovery, because first of all, what you did is you just told people, okay, just stay at home, so don't spend. Therefore, if you lift the lockdowns, allow people to spend again, they will spend, and it's back to normal. The problem is, after learning more about what's going on and how it may be difficult to normalize things, doesn't look like we'll have a V-shaped recovery, maybe more of a U. So the question is, yes, we're going to be better maybe in the third quarter relative to the second quarter, but is it going to be back to pre-ECQ level? Maybe not. That's a difficult question. Definitely, the banks already said that they're anticipating more non-performing loans going forward. So it's interesting to see what will happen. So it's different from that perspective. A lot of questions that need to be answered.
All right. Thank you, Ms. Tan. What about you, Sir Tantiangco? You have something to add?
Okay, three things. There are three differences that I can point out between the crisis that we are experiencing right now and the past two major crises that we had, which is the Asian financial crisis and the global financial crisis of 2008. Now, the Asian financial crisis and the global financial crisis of 2008, unique as they are in their own ways, somehow they still had similarities in terms of root core problems. There was the presence of excessive borrowing, excessive risk-taking, unsustainable debt levels, unsustainable spending, which eventually led to the bursting of the asset bubbles and consequently the economic collapse. Now, if you're going to look at it carefully, these are economic in nature. Now, present time, yes, we are experiencing economic problems like loss of confidence, capital flight, and weak aggregate demand. But these are all presupposed by our major problem, which is the pandemic itself, the coronavirus. So if before, we were only dealing with one problem, which is the economic problem. Right now, we're getting hit by a twin dagger. And this calls for, of course, two solutions, the health solution and the economic solution. And this is where the dilemma comes in. Uh, uh, if you're going to look at it, if you want to resolve our health crisis, it will be at the expense of our of our economy. If we want to jumpstart the economy, bring us back to our full productive capacity, this will be at the expense of the health of the country. So this is the second difference between the crisis right now and the crises back then. Now the third difference that I want to point out is the pace. In the 1997-1998 Asian financial crisis, yes, we hit contraction territory, but it happened at a gradual pace. We started 1997 quarterly. We started 1997 first quarter year-on-year growth was at 5.1%, and then we hit 6%, and then we went back to below 5%, and then below 2%. And then that's when finally the contraction happened. The global financial crisis of 2008, we did not contract. Growth slowed down, but again, this was also at a gradual pace. Now, if you're going to look at the economy right now, remember that in the fourth quarter of 2019, we had a 6.7% year-on-year growth. And from that, immediately we dropped to contraction territory of a negative 0.2%. So this did not happen in a gradual pace. Rather, this is a one fell swoop. And this explains why there was this steep decline, this precipitous slide, which happened in the first quarter of 2020. At the same time, given the differences that I have pointed out, we can see that this crisis is unprecedented, and this is causing much uncertainties on the part of investors, which in turn is reflected on how the market is moving right now.
All right. Thank you, Mr. Tantiangco. What's interesting about your the points that was shared by the speakers is that before, in previous crisis, you either have a health crisis, a financial crisis, or a political crisis. But for the COVID-19, it's a combination of both, or at least for the first two, you have the health and the financial. So I think, in a way, it's kind of unprecedented. Now let's move on to the next question, which again I'll be directing to Mr. Monzon. So, sir, the question's about IPOs. So
Yeah.
I remember before the PSE was initially targeting 6 IPOs this year. So
About 2 or 3 REITs,
sorry,
plus about 2 or 3 REIT listing.
yes, sir, plus 2 or 3 REIT listings. So given current market conditions, is there a revision to the target?
Well, obviously, we would be dreaming if we stick to our original target. Okay.
Right.
So far, we've had one listing by way of introduction. We're having an IPO for June. For the rest of we have application for one REIT listing. For the rest of the year, I think we would be lucky if we could get 2 or 3 additional companies to list at this time. So definitely, we've brought down our targets for the capital raising activity of the exchange.
All right. Sir,
Yeah.
maybe as a follow-up, or Ms. Tan.
Yeah, can I just add there?
Sure.
Yeah. So right now, I think we're hearing that Merry Mart will push through with the IPO. I think they have two advantages as far as listing is concerned. First is the business that they're in. They're into essentials, And based on discussions with other listed companies that have groceries, for example, RHI disclosed their earnings, and it was really very strong because although they also have retailing in fashion and other products, the grocery and the drugstore business did very well, offsetting the weakness or largely offsetting the weakness in the other categories. So at least Merry Mart is into essentials, and most likely the performance is still going to be resilient. So that's one of the things going for it, and it's a small sized IPO. And last year we saw the performance of smaller IPOs outperforming those of bigger IPOs. Secondly, Ayala was in the headline saying that they are looking to push through with the REITs. And I mean, one of the I think differences this time around compared to the past is that central banks have been very aggressive in cutting interest rates to the point that time deposit rates now in the bank, even if you have a lot of money, is below 2%. um, so there is now a search for yields among investors. I mean, if people pre-ECQ were already looking at yields, now with rates so much lower, there might be some demand for a product that provides higher rates. And so far, based on the our discussions with property companies, the office segment still looks resilient. I mean, of course, the malls are going to be hit because the stores are asked to close, and of course, the retailers are asking for discounts as far as rental rates are concerned. But so far, the offices are still okay. BPOs are still there. Now, if after a few months this remains the trend, then there might be some demand for office REITs, given how low interest rates are, and assuming that office rents are more resilient. So we might be able to do those.
All right, thank you, Ms. Tan. What about you, Mr. Tantiangco? You have any additional insights on the
Well,
matter?
given the economic landscape right now, wherein the outlook remains dim, and there's still a lot of uncertainties, especially with the COVID-19. There's really not much incentive to raise capital in order to fund your capacity or your operational expansion. That is unless, of course, you see or you project that
Um, I think we're having technical difficulties for Mr. Tantiangco. Sir, are you there? Hmm. Yeah, in that case, maybe we can momentarily move on to the next question.
Can I say something? I mean, you were asking me about the Merry Mart IPO,
Sure.
and April was talking about it. Actually, last Saturday we gave our final comments on their application, and we basically had them, take out some things in their final prospectus, which had to do with their optimistic targets on store openings, and we also required them to make a very, very prominent disclosure on the fact that what that a month before the I guess controlling shareholder subscribed to shares at 5 centavos, and now it's being marketed at a target price of 1 peso. So we wanted to make sure that disclosure is uh, prominently done in the prospectus, and they agreed to it. And so yesterday we gave them the go signal, and they're now going on their book building, and they have a target listing date of June 15.
All right. Thank you for that, Mr. Munzon. Maybe as a bit of a follow-up regarding IPOs and REIT listings. So suppose even after market stabilize, right, after this COVID-19 episode is over, how long do you think would it take for companies to be confident enough in the markets in pricing their IPOs and listings?
Well, two things. Number one, even before the COVID-19 crisis, uh, at the PSE, we were experiencing, I guess, reduction in, in the number of or in the amount of capital raised in the equity markets. Okay, we saw that a lot of the capital raising was being done by the companies in the fixed income market. In fact, in terms of capital raising, the share of the equities market from 2015 we were at 63.2%, 2016 56.7, 2017 45, 2018 42.3, 2019 20.2. So you can see our share in the amount of capital raising has been going down while that of the fixed income has been going up. And that is easily explainable by the fact that our BSP or Bangko Sentral ng Pilipinas has been liberalizing interest rates, having a series of rate cuts, increasing liquidity by having a series of reduction in the reserve requirements, making it cheaper now for companies to raise capital in the debt market rather than in the equity market. So having said that, I mean, sure, I mean, so I said even before the COVID-19 crash, we were already experiencing problems in the number of IPO or number of companies that wanted to raise capital in the equity market. Now, we talk about IPOs. Of course, as you know, our market is down. So the PE ratios of a lot of the blue chip companies are down. So it would be very difficult for I guess a company to undertake an IPO now, because in effect they would be competing with with some well-established companies already that have been in the market for so many years. So I think they will be more careful as far as going to the equity markets concerned. So having said that, I'm not too optimistic that we will have too many IPOs for this year.
All right. Thank you for that, Mr. Munzon. Right. Yeah. Let's proceed to the next question. Actually, this talks about, well, stock recommendations. But I understand COL Financial, your recommendations are limited to your clients, right? But maybe at least for Ms. Tan, maybe you can share with us. Actually, you've already shared this in your opening remarks, and maybe you would like to expand on that with regard to the sectors. Which of the sectors do you see as interesting, maybe in terms of upside or valuation? And in contrast, which sectors would you not recommend?
Okay.
Sorry. For Mr. Tantiangco, maybe you'd like to share afterward.
Okay.
Ms. Tan, go ahead.
So yeah, earlier on I talked about the sectors that we liked, and those would be the retail sector, but on essentials like those involved in groceries, and the telco sector, and those that produce food manufacturers, and some utility companies, power companies, because those companies will be more resilient to the ongoing crisis. And if you observe how the market has been performing lately, it seems like there is no appetite for sectors that are really very vulnerable to the ongoing crisis. So that said, we think what will happen is that will continue to be the trend. But again, the problem is in terms of valuation. Um, these stocks are not cheap anymore right now. They have gone up quite a bit. In fact, if you look at the telcos, they are actually, if I'm not mistaken, trading above their end 2019 levels. So naka-new high na sila. Um, so people are really pricing in the recovery or the stronger outlook of these stocks. So in that respect, I think we have room to wait for prices to go down. For example, um, PLDT and Globe disclosed their earnings, and they said that they too are somewhat affected because in the second quarter they guided that revenues will most likely be lower relative to the first quarter, as um, prepaid cell phone subscribers are no longer topping up as much on their cell phones because they're at home anyway. So they're just using their home broadband. So in that respect, maybe it's too premature for us to be aggressively buying them at the current price. So there may be opportunities to buy them. On the other hand, those sectors that are very vulnerable, they are really crazy cheap. So, for example, the banks right now are trading at below book value. The big three, which are Metro Bank, BPI, and BDO, are trading at 0.85 times price to book value. Whereas the smaller banks, those that are not part of the big three, are trading at 0.48 times price to book value. So really cheap. Property companies, if we including SM Prime, average PE of property companies is 9.7 times. If we take out SM Prime, it's just 7.2 times. So these stocks are really cheap. The problem is they are expected to be among the most hit. So that said, people still don't want to buy them.
Yeah, thank you for that, Ms. Tan. What about you, Sir Tantiangco, regards to sectors
Okay.
recommendations?
Okay. It's easier to point out in times like these which sectors we should avoid rather which we can choose from. So let's start from that. Given the impact of the pandemic, I suggest that we stay away from those which are heavily exposed to the tourism sector. Not only did it experience a big hit because of the travel bans implemented, but because moving forward, if you're going to look at the outlook, it remains dim. I mean, first, with low disposable incomes, there won't be much traveling happening. At the same time, of course, people are, there's still the lack of willingness. People are not really that into traveling into the near future in fear that they might have obtained the virus. So stay away from these sectors. Number one would be the air transportation sector. You also have the hotels and the gaming corporations. You also, I would suggest staying away from the property sector for the meantime, especially those which are heavily exposed to, again, hotel operations given the COVID-19 and its impact on the tourism sector. Those which are exposed to high levels of whose portfolios have a big portion of portfolios are into mall operation, given that social distancing measures are expected to reduce mall foot traffic. And finally, those which are heavily exposed to residential sales, given the decline in disposable incomes, as well as the repatriation of of most of our OFWs, which are contributing heavily to the said segment. Residential sales are expected to take a hit for the property sector. Now, which sectors could I? Finally, I suggest you would also stay away from the mining sector. If you're going to look at the GDP breakdown on the supply side, they were one of the worst hit. Year on year, declining by more than 20% in the first quarter of 2020. Now, which sectors should we look into? Now, I can propose three categories, okay? Because right now, as much as possible, we need to look after sectors, industries, or businesses which can have the most advantages possible, given this crisis. So, number one, I suggest we stick with the defensives. Look for companies whose goods and services have inelastic demand, meaning to say these are the essentials. Included in such are our utility companies. You have our electricity, power, water, telecommunication, consumer staples. Next would be companies that enjoy a lesser degree of competition. In times like these, wherein disposable incomes are declining, what a business would want the least is to have is to wrestle with other businesses just for that remaining income that the consumer has. So for that, I suggest again, you go for companies that enjoy market dominance, huge market dominance, or a degree of a monopoly in their franchise areas or in their sectors. Again, if you're going to look at it, mostly it's going to be the utility sector, the telco sector, which is under a duopoly for now. And then you also have again your electricity distribution, you have your water distribution. So those are the things that you can look into. Finally, look for stocks with silver lining opportunities. With the new normal is ushering in new economic trends. One of which, for example, is the move, the louder call for the digital space, the use of more online transactions, like e-commerce, e-learning. Most are being they're trying to most are being transferred to the online. So with that, of course, there's an expected increase in data demand. So from the looks of it, it's going to be the telco sector, which is going to get the benefits from it. So again, to summarize, you look for industries with that are giving that are selling in the essentials business, that are selling essential goods and services. Look for industries which are enjoying a lesser degree of competition, and finally, look for businesses with silver lining opportunities. If you're going to use all of these categories, you're going to see that what will stand out the most is our utility sectors.
All right. Thank you, Mr. Tantiangco. I think the next question, I think at this point would be catalysts. So with investors and traders looking for leads, given the first quarter GDP, for instance, already reporting a 0.2% decline, what do you think are developments both at home and abroad should investors and traders look out for in the months ahead? This is addressed to everyone, by the way. So
Okay, can I start with it?
yeah, sure. Go ahead.
Okay. Yeah. So I think the main catalyst would be indicators that would point to, the new normal, or the new normal going back to pre-ECQ normal. And what would trigger that? There are interesting surveys out there actually asking people, what would make you take a cruise or fly and take vacations, do things that normally you wouldn't do now because you're worried about the COVID-19. And for them is number one, infections will be zero already. So in other words, convincingly being able to beat the COVID-19 pandemic. And that could be because you have, number one, have a vaccine, number two, have a treatment, number three, have herd immunity. Because, interestingly, the Spanish flu did not, when they eradicated Spanish flu, it wasn't because they found a vaccine, or found a treatment. It was simply because after a few years, you had herd immunity. And maybe this COVID-19 pandemic is something that we can solve either with a vaccine or because of herd immunity. And that could be as early as maybe next year or as late as 2 years later.
Right. Wonderful insights, Ms. Tan. For Mr. Monzon and Mr. Tantiangco, any additional insights?
Well, like both our panel members have already mentioned, I think there's going to be a new normal now. I mean, people are, starting to or institutionalize the work from home practice for their employees. At the exchange, as you know, we've closed the trading floor. We've gone on a floorless trading. And my managers and I are working on, transitioning to a work from home environment for at least 50% of our workforce. And of course, like what we're doing now, we're doing a forum online, with a platform. So obviously, all these platforms for virtual meetings and forums will be something that will be in very high demand in the next, next few years.
All right. Thank you for that, Mr. Monzon. Mr. Tantiangco, you're there? Yeah, it seems that we've lost contact of him again. So right now, we're going to move on to the audience Q&A portion. So I think we still have time for one or two questions for this one. So the first would be from a Larry Escoro. So this question is addressed to Ms. Tan. So you appear to have indicated that we haven't reached the bottom yet. When do you think this is likely to happen, and what will be the triggers?
Yeah, I guess, given that, I mean, earlier on, I think baga yung question now, what do you think will be the catalyst? I guess
Yeah.
if we all of a sudden find a vaccine tomorrow, de wala na tayong pag-usapan. I mean, it's a different ball game. The market will probably go up already. And in fact, the sectors that we said to avoid will probably be the ones to go up sharply because they're really cheap and people are avoiding them because I think the status or what the people are expecting to be the new normal is social distancing, companies having problems, etc. But if, let's say, a vaccine is found tomorrow, I think we won't hit a bottom anymore. But assuming that it doesn't happen, which is I think what the base case is, people are feeling that it will still take time. We are just looking at previous financial crisis where markets fell by around, say, more than 50% from the previous high, which is something that, yeah, we've seen when we hit the 4,000 plus level, but maybe something closer to that level, or when we hit maybe 8 times, 9 times PE, then those are, much cheaper levels if you ask me to pick up stocks. I'm not saying that stocks are not cheap now. They are cheap relative to historical averages. It's just that, if you continue to hear bad news, then I guess the buyers will continue to stay away. Parang wala pa rin silang gana. And then alam nila in the past financial crisis, stocks bottomed when they were down 50%. Of course, if you use that as a reference, you will wait until stocks are down by that much and prices go back to previous levels, which was 8 times, 9 times PE.
Thank you, Ms. Tan. How about you, sir?
Well, I mean, I'm in the business of running an exchange, not making recommendations. So I will defer to April on
Well, maybe
recommendations.
more on the question of bottoming out. Maybe you can answer that, sir.
Well, again, I mean,
Yeah.
bottoming out, we reached an intraday low of 4,061 sometime in March 19. I'm hoping that would be the bottom. I guess what concerns me is that a lot of the countries are, getting out of their lockdown status. We are scheduled, hopefully, to go out of our ECQ on May 31. So what only concerns me a lot is, hopefully, after all these countries and even the Philippines go out of their EC or their lockdown or shelter in space, as they call it in the States. I hope there's not really a big second or third wave that will, result in, new lockdowns again. Then I think that will really drive the market much lower. Like I said, and like April said, what we're looking forward to really is a discovery of a vaccine, and at least prior to that, some improvement in treatment protocols for the late stage, infectees of this virus.
All right. Thank you, Sir Munzon. Mr. Tantiangco, same question, I guess, regarding bottoming out of the PSEI. When is it going to happen, in your opinion?
Okay. I would just before that, I would just like to go back to the question a while ago. First, I really sincerely apologize. We have a poor internet connection right now. But again, catalyst. What we would really need is a vaccine, a potential treatment, a cure. Only by solving this health crisis, can we really start talking about a full recovery of the economy. Of going back to our full productive capacity. Now, as for the current status of the market, as we saw a while ago in the charts, we failed to sustain that rally that we have. We failed to follow through after reaching that high of above that peak of above 5,900. So right now we're being hindered by that 5,700 resistance level. It is a strong resistance. So given that, we expect a consolidation for now. Between the 5,300 to 5,700 range. Over the long haul, it would depend on the development of the narratives. So far, the market still has a downward bias given the dim economic outlook. The next thing that investors would be looking towards to right now would be the second quarter GDP. We are already expecting a contraction given that we've experienced longer quarantine periods this period. Plus, we're still dealing with the same pandemic. So we're still expecting a contraction. But if it turns out to be deeper than what is initially expected, most likely a high single digit contraction, then we could breach that 5,300 support level and visit its next support, which is at 4,850. Now, if we do get that catalyst, that vaccine, that potential treatment, then this will give us a fighting chance against that 5,700 resistance, and eventually with that our next target would be the 6,100.
All right. Thank you for that, Sir Tantiangco. Here's another question from a certain Ricky B. Llanes. I think this is more addressed to Mr. Munzon, but I think Ms. Tan and Mr. Tantiangco can also answer this. What new innovations can PSE provide for potential small investors who would like to trade from home?
Well, for PSE, our trading platform and our front end allows for investors to trade from home already, trade online. In fact, April's brokerage, COL Financial, is one of the biggest online, stock brokerage in the country. For IPOs, as you know, recently PSE has launched what we call the PSE EC platform, which allows investors from all over the world to subscribe to new IPOs electronically without them having to go to any office or kiosk to get application forms and make payments there. So on the IPO side, I mean, that's already been, I guess, we've already enabled investors to invest from home. And for non-IPO stocks, like I said, there have been online trading platforms for some years now.
All right, thank you, Sir Munzon. Ms. Tan, Sir Tantiangco, maybe you have something to add to that?
Well, I think for us, we just I think what has changed as far as COL Financial is concerned, we now accept online applications. So that should help with the account openings of the clients. And of course, we do our best to make sure that our platform is always available.
All right, Mr. Tantiangco.
Well, with Philstocks, it's the same. We also have an online platform which allows small retail investors to trade at the comfort of their homes, and you can submit online applications. You just go to our website, that will be philstocks.ph, and surely our sales team would be more than happy to assist you.
Right. Thank you for that. Right. So for now, we're getting close to the end of the session. So I think this is the time where each of the speakers would air their closing remarks. So for the panelists, if there is one thing you would like the audience to take away from this session, what would it be? Let's start with you, Mr. Tantiangco.
Okay. Well, as it's already the talk of the town, we are going into a new normal. Now, the precipitous slide that we experienced in the first quarter of 2020, it will have a lasting impact on market psychology. Most investors, especially new ones, would choose to shy away from the market or either secure gains as quickly as possible as per the principle of loss aversion. So this is something that needs to be addressed. And I think the best way to do this is to expand financial market education. If this is left unchecked, then it may serve as a challenge to the market's recovery. At the same time, hopefully from the precipitous slide, my hope is that some of us have taken the opportunity to learn in terms of managing our risks, cut losses when needed, throw away those market psychological biases such as overconfidence, herd mentality, and as mentioned a while ago, loss aversion. And again, try to discover new strategies, but stick with the core guiding principles of the market, the theories, both fundamental and technical. And as for the market in general, the new normal could usher in a new economic trends. Uh, uh, the way I see it, there would be a bias towards a more healthy lifestyle. At the same time, there will be ventures, perhaps on food and or agricultural sufficiency and sustainability. Finally, as mentioned a while ago, there's going to be a louder call for for more of the digital space in the economy. So those companies which will be able to find opportunities out of these, they will likely be the new favorites of the market. So just watch out for them. Eventually, again, we are dealing with an unprecedented crisis. It's a twin dagger again, a health and an economic crisis. Our best hope is that both of these will get resolved, especially the health crisis. Once we resolve this, the economy would be much economic problems would be much easier to deal with. Until then, let's practice caution, due diligence, and again, there's always opportunities so long as you employ the right strategy and manage your risk. That's all.
All right. Thank you, Sir Japet. Ms. Tan, your turn.
Yeah, so I'd like to close the my part at least with a quote from Warren Buffett that said, "Be greedy when others are fearful, and fearful when others are greedy." And definitely now is a great time to be greedy. The problem is, think about it. It's so clear that it's a great opportunity to buy the market. So how come not a lot of people are actually able to hold on to their positions? Um, that is because bear markets are very tough. They are very scary. Once you've been in it, making you question whether you made the right decision. And right now, the market has gone up a lot from the 4,600 low that it went through. And although it looks like it could continue to go up, we feel that that is not the right strategy during bear markets. During bear markets, like we don't even know where the bottom is. We are saying at this stage doesn't look like it, but of course, as I've said earlier, if we see a vaccine tomorrow, then maybe we won't even do a retest of the 4,000 level anymore. So that said, risk management is very important. So we're saying, yes, buy this market, but make sure that you will be able to hold on to your positions for a long term. So you can do that by managing your risk, just buying slowly, only buying a small amount that you're sure you can keep for the very long term, and wait for a year or two, and I'm quite confident that you will actually be very profitable.
Fantastic. Thank you for that, Ms. Tan. Lastly, Sir Munzon.
Well, like I said earlier, I'm not a market analyst or a market guru. I run the exchange. But what I'd like to just say is that I mean things look bad now, and I'm an eternal optimist, and we've seen four bear markets. We've seen that historically, uh, all those bear markets have recovered and, in fact, have reached new highs. Of course, like again, everybody's saying the COVID-19 problem is not like the global financial crisis or the Asian crisis, but I think the message is in the long run. I think the market will eventually recover. I don't want to predict how long it will take to get back to the previous high. So, in spite of four bear markets, we have to understand and realize that if you study the returns of equities versus, let's say, you know, ba- uh, savings account or time deposits. Historically, in the last 25 to 30 years, investing in the equity market still trumps, investing in or putting your money in the bank. So looks bad, but I think, like I said, things will recover eventually.
All right. Thank you, Sir Munzon. Now, this concludes phase one of Business World Insights, an online forum series on laying out the macro scenarios for businesses. Please tune in again starting May 27 for our second phase of the online forum series, this time with the theme, The Aftermath, Lessons from the COVID-19 Pandemic. Be sure to follow Business World on our social media accounts for more updates. Now, I'd like to take this opportunity to thank our speakers for taking the time to share their insights with us. This has been a very fruitful discussion, and thanks, guys. For those who just tuned in or were not able to join us from the very beginning, a recorded version of this webinar will be uploaded later in the day in our website, bworldonline.com, as well as in our Facebook and YouTube pages. Also, I'd like to thank our sponsors for this forum, the SM Group, Megaworld Corp, Globe Telecom Inc., PayMaya Philippines Inc., and the National Home Mortgage Finance Corp. Finally, I'd like to thank our audience for tuning in. We hope this session has helped you guys with regard to the direction of the stock market moving forward. And once again, I'm Leo Uy. Have a nice day, everyone, and stay safe.